Shires Income is an investment trust whose objective is to deliver a high level of income together with growth in both capital and income. And it does that by investing substantially in UK equities, but we also have some investments in preference shares and one or two convertibles. Income is vital to the trust. It goes to the very core of what it is that we're trying to do. We make 4 quarterly distributions, currently 3p each. One of the things that people sometimes say to us is, Ed, why do you have some of these lower yielding businesses in a trust that is so geared towards generating income? And it's because we recognise that a high initial yield, but without growth in the income for our investors, is not attractive for them. Ultimately, it will be eroded by inflation. By having some of these often lower yielding companies, that's where our potential for future growth in income will come from. In terms of the businesses that we're invested in, it's difficult to characterise them all, but a lot of the themes that come out are high levels of recurring revenues or high level of aftermarket revenues, businesses where the businesses is important to the customers as the customers are to the business, companies that have got pricing power, for instance, companies from a financial perspective that have a strong balance sheet. I think a strong balance sheet is crucial. Now, there are certain businesses that are attractive to us, and so you tend to see that we are underweight the oil and gas majors because they're such an enormous part of the sector. We don't think you can really have a sensibly diversified portfolio that's got the kind of weightings that Shell and BP are in the index. We tend to be underweight the mining companies, where the miners are quite interesting. I think that's a classic example of where a low PE doesn't necessarily equate to a cheap company. As fundamental bottom-up investors, we think it particularly suits our skill set to invest in small companies. However, we also recognise that it is difficult to have a diversified portfolio within a portfolio if we invest in small companies directly. And so we use a vehicle called Aberdeen Small Companies High Income Trust, which is an investment trust that we run on the desk. So the whole team is intimately familiar with the businesses that are in that portfolio. But by using that vehicle, we get exposure to maybe 41 companies in the portfolio. This brings a diversified exposure that we wouldn't get if we invested directly in perhaps 6 or 7 small companies. They might be good companies, but to our mind, there's disproportionately more risk by doing that. We don't buy stocks and shares, we don't trade, we invest in companies. And in order to make those kind of decisions, we have to engage in some really rigorous proprietary research, our own due diligence. If you were to come down and look at my desk now, or the team's desk, you wouldn't see it covered in broker reports. You'd see it covered in the work that we've been doing on the companies that we've been researching. We believe that we should be a team rather than a set of stars, and therefore everybody, from the most junior people to the head of the desk, has input in terms of the companies that we're going to invest in and how we're going to construct our portfolios.